very recently we bought a small tax business. And that was quite exciting, buying another business. But what was more exciting was all these boxes arrived into our offices with all these old files. And in these boxes, I found some really, really old tax books. I found tax cases going back to the 1890s. And I also found Willen's tax tables going right back to before I was even born. I was so excited, I put them on the top shelf in the office and nobody else can reach them. But yes, quite excited. And I was even more excited this year because we've had 3 budgets, and that's quite exciting for tax people. Yeah, no? Right, before I start going into tax, who here cares about tax? Because I'm not going to talk if 1, 2, 3, 4 people, okay. So all 4 of you, I'm going to lecture for you on the tax side. The rest of you, I don't know, you can fall asleep in between. Oh, just turned it off, I think. See if I can work it. Does anyone know how to work it? But what I want to do today, I want to cover some of the budget update stuff. Now, what do you most want to hear about? Is it dividends? Who cares about dividends? Oh, that one, thank you. Who is obsessed with the increase in the dividend rate? Yeah? Well, do you know what? I heard something really, really good after this. How many of you would ever park at a broken meter, a parking meter? And dividends are like that broken meter, right? You've been parking outside it for years, and now somebody's fixed it, and you're really, really upset. And you know what? If you go and look at the price on that parking meter, it's not actually more than the price of parking anywhere else in town. So if you think about dividends, that's probably where we are. But I can tell you one thing, it isn't George Osborne that's behind this, is it? Because have you looked at the numbers? I don't know whether you were, but back in 2014, somebody asked George Osborne, I think it was a little 7-year-old boy, he said, what is 7 times 8? George Osborne refused to answer the question. Do you guys know what 7 times 8 is? Did someone say 60-something? I'm seriously worried. I'm in a room full of accountants. Well, anyway, George Osborne refused to answer that question. And that's why we know this dividend stuff is not from him. But just very quickly, what we're going to have is the new system is going to be completely different to the old one. The 10% tax credit, as we know it, is going to disappear. Now, this 10% tax credit, this has been really, really causing people some stress. I did Moneybox on Radio 4 2 days after this announcement. And I had somebody phone me up and he says, what's going to happen to my 10%? I'm going, well, it's not really 10% because it's notional. It doesn't exist. He goes, who's keeping my 10%? I went, no, there is no 10%. This is all notional. And he said, so the company's keeping my 10%. And I thought, how many ways can I say there is no 10%? And I'm going to the producer, cut him. But if you look online, there's loads of forums looking for this 10%. And there are loads of pensioners saying, somebody's keeping our 10% tax here and I want that money back. There is no 10%, okay? It's a legacy from ACT. So now what's happening is that's going to disappear. There's no more confusion. No company ever pays money over to the government on your behalf on your dividends. It doesn't happen. So what we're going to have is a change in the rates. So the basic rate's going to go to 7.5, higher rate 32.5, and your additional rate 38.1. The good news is we're all going to get a 5,000 tax credit in relation to dividends. So that's good. You're going to have 0%. There's a bit of planning there, isn't there? When you think about some planning, maybe grandparents subscribing for shares in companies, then gifting those shares to their grandchildren, those grandchildren all getting 5,000. We're not caught by the settlements rules because they didn't come from the parents. So you might want to think about some planning around that. But it's exciting times for us. And if you work through these numbers, now this is the brilliant bit, I love this. If you look at incorporation versus sole traders, right, what you're trying to see is when are you going to be better off. And if you look at the way the rules work, at the moment, the current rules, the way the dividends work, and compare that sole trader and this one here. This is the most important one. You see, because we have a tax lock, there's going to be no increase in the rate of income tax. But if you work these numbers through, what's the rate of tax for an additional rate taxpayer on dividends? What's the effective rate? 50%. And that's why we know George Osborne didn't do the maths behind this, because he would never have got to that. But this is actually very clever. So if you sat there on budget night thinking, actually this is very knee-jerk reaction to something, it's not. This has been very well thought out. What's even better, if you look at those numbers, can you see anything else that would come out of those? IR 35, who cares? Because if the difference between taking dividends and salaries is so small, well, we don't actually need IR35. Because the big issue on IR35 was the loss of that tax. Call it tax, call it national insurance. Who cares? It all goes into the same pot. It doesn't actually matter. And the reason national insurance is not added to tax is because then they'd have to say the tax rate's more than 50%. But in reality, your national insurance is just a tax, isn't it? Yes. So 50% tax, had you worked that one out? That's what you have to tell your clients. So what should you be doing on the dividend planning? Well, first of all, you need to tell your clients to stop getting upset about it because the parking meter has been fixed. But what they need to think about is what are they going to do going forward? And I think what you need to do, you need to work with your clients, crunch through the numbers, see where you're going to come out. Have a scope for family members and companies. So if everyone has their own 5,000 credit, how can you use that up in the best possible way? Because even if you have someone who's a higher rate taxpayer or an additional rate taxpayer, it may be still worth passing some shares to them in order for them to have some dividends because they're going to have that 5,000 tax-free. And if you have got the cash in your company, you may want to consider accelerating the payments of some of those dividends. Of course, there's loads of other planning around that because you may have clients who've built up quite a substantial amount of money in their companies and they're probably thinking, how am I going to get that out? Now, I don't do tax schemes. I haven't got anything magic I can give you to get that out. But think about where your client is in the life cycle of their business. Are they coming towards the end of their life cycle of the business? If they are, there may be scope to maybe liquidate an existing company and just continue as the sole trader. There may be scope to do some reorganization if they have got two separate businesses within the same company. So there may be some planning in there that you can look at. And of course, looking at how you may reduce your tax by having some pension contributions as well, there may be some scope in there. And we know the rules on pensions have changed quite a bit. And for some very fortunate people with the changes in the pension input periods, some people have had an 80,000 allowance this year. And if you haven't used the allowances, of course, you can carry it forward. Now, going on to next year, there is going to be a restriction for individuals who earn more than £210,000 that they're going to be restricted on the amount they can put into a pension. But if they have unused amounts, then they'll be able to carry those forwards. So what you might want to think about is there any scope for putting more money into a pension and thereby reducing the corporation tax rates? But yeah, very good. The changes in dividends, very, very clever and very well thought out. Moving on now to look at the annual investment allowance. How many people think this is of value to their clients? Yeah. And the bad thing is as advisors, when do we know they want to rely on this? It's at the end of the year, isn't it? It's when we're doing the end of year accounts, we're doing the computations. And the difficulty is that we're working in hindsight to see whether or not that AIA is available. And what we should be doing is going to our clients in advance to say, look, this is how the AIA works and this is what's happening. Because, yeah, this is another classic George Osborne example of being very good at maths. So he stands up and he announces that from the 1st of January, I will be increasing the AIA to 200,000 per year. And everyone's going, I thought it was 500,000. It's going down. But what he meant was, it was to fall back to the permanent rate of 25,000, but instead 200,000 is going to become the new permanent rate. So 500,000 to 200,000 is an increase, if that makes sense. But where is it important? Well, if you're looking at your client's accounting periods, so take this example here, what you have to work out is how much is your client entitled to. Because it could be if you have a client whose accounting period ends in March 2016, which began on the 1st of April 2015, you might be saying to them, well, actually, you're okay. You're going to get 500,000 because that's the rate in force. Well, that's not strictly correct. Because what you've got to do is look at how it spans the accounting period and work it out. So you have your 9/12ths at the 500,000 and you have 3/12ths at the 200,000. And 425,000 is the maximum amount that they can have in that period. And of course, if they haven't already spent their money, they can't spend the whole 425,000 in here. They're restricted to that 50,000 because that 375,000 has to be used up in that period. So you have to split it up into notional periods. And that's where it can get tricky So what you need to be doing is advising your clients that that AIA rate is going to come down to 200,000, and they need to be looking at whether or not they need to be accelerating any large amounts of expenditure to ensure they get the full 100% relief. Corporation tax. How many rates of corporation tax have we got? Too many. No, we haven't got too many. Well, we've got the large companies rate and the small companies rate. So what's the large companies rate? 19 from 1st of April 2017, 20% at the moment. What's the small companies rate? 20%. So do we need two rates? Does it matter? Small companies rate? We do. The reason we need the two rates is because you need to look at whether or not your company is paying at the small companies rate or the large companies rate, and if they are, whether they have to make these quarterly payments. So that's why it becomes important. We've also had changes in relation to associated companies. Who cares about associated companies? I care about them. I care about them a lot because I used to have a case years ago where I had a couple who separated, but they wouldn't divorce. They lived at opposite ends of the country and they each had their own companies, and those companies were associated. So every year they had to divide down their profit limits because they were associated companies. The fact that they didn't speak to each other didn't matter. They were still a married couple, so they were associated. The way the rules have changed is that associated companies now, you need to look at group companies. So it's a group association. So if you've one company that's a 51% subsidiary of another company, then they're associated companies. You're looking at me blankly saying, why is she telling us this? We don't really care, the rates are 20%. The reason I'm telling you this is because if you're trying to work out your quarterly payments and whether or not you fall into the installments options, you need to look at the number of associated companies. And what's the first thing most people do when they're preparing a tax computation? They go, oh, right, last year we had 7 associated companies, this year we have 7 associated companies. So what I'm saying to you is you need to look at your accounting software and your tax software and to make sure that you're adjusting the number of associated companies so you don't bring your clients into the installment payments before they actually need to come into the installment payments. And if you look at the way the installment payments are going to work, they're going to accelerate anyway so that you're now going to be paying your tax even sooner. So what you don't want to do is to bring your clients into the installment payments unnecessarily. So our rates are going to go down to 18% from the 1st of April 2020. It's a good rate, isn't it? I'm going to say something later on when I come on to look at property rental and the portfolios and the corporation tax rate. And I'm not trying to scare you, but I will tell you. Oh, how many people here have incorporated a client's business where they have transferred goodwill and claimed 10% tax and done a write-off for the goodwill in the company? Yeah. It's a bit like that broken parking meter again. You know, the broken parking meter, we're all using it. And it's now time to pay up. So there's a couple of changes going on. The first one was announced in December. And what the first one was looking at was if you incorporate your business, i.e. you transfer your goodwill and customer-related assets to a limited company, then the individual making the transfer will no longer qualify for entrepreneur's relief on that transfer. So it means it's not a business asset anymore. So you don't get your 10% tax. And then on the flip side, the company who's acquiring the goodwill or customer-related assets, and assuming they're post-2002 ones, they will no longer be entitled to a corporation tax deduction for that goodwill. Now, that was a bit of a shock. But if you had valuations going on with the revenue and you were dealing with shares and assets valuation, you knew they were looking at goodwill and they're not very happy with everyone transferring this goodwill into a limited company. So that was stopped from December. I have one of my clients, he's a very nice guy, he's a Portuguese guy, runs an antiques business and has been in the UK. Well, it's debatable. We have debates as to whether or not he's deemed dom. He says he's not, I think he is. But he's been in the UK a long time and he runs his business as a sole trader. For the last 5 years, he's been talking about incorporating this business. In August, he went, right, Paula, I'm going to do it. I'm going to incorporate. I went, great, brilliant. When are we going to do it from? He goes, the 1st of January. So I had to phone him up on budget night and I had to say to him, look, you know all that great stuff we're talking about for ages? Well, technically you can still do it, that works. You can incorporate your business, but that lovely 10% tax rate I've been talking to you about, you're not going to get that anymore. It's going to be 28%. Now, he was never going to get a write-off for his goodwill, so that didn't really matter. But what I did say to him is, there's another way you could do this. What about, I said, you just incorporate using Section 162. Are you familiar with that? Incorporation relief, where you transfer your business to a limited company in exchange for shares. You don't trigger capital gains tax. So what I said to him was, well, what about you do that, and instead of just taking ordinary shares, we do some redeemable preference shares. That could work. He's like, I like the idea of that. So what we can do is we can incorporate his business, give him some redeemable preference shares, and in the longer term, he could redeem those shares, provided he's got 5% of the ordinary share capital of the company, is an employee of director, held the shares at least 12 months, then he'll probably get entrepreneur's relief. So he doesn't actually need to rely on this, but he still hasn't incorporated. We've moved on now. We're going to do something else for him. I think that moment has passed. But having had that announcement, we thought that was the end of it. And I had been to an international conference. We have a new international network. It's great. I went to Madrid, and I'm going to go to New York in a few weeks' time. I'm just waiting for next year's as well. This traveling is brilliant. But I went to an international conference, and I was at the top of the room, and I was talking on diverted profits tax. I'm not talking about that today, but diverted profits tax, I was up talking about that, and somebody puts up their hand and they said, can you tell me about the Intangibles Regime in the UK? Because I'm from Switzerland, and the Swiss authorities are looking at how we do this, and we think the UK has such a fantastic system, we're going to follow it. So in New York, I'm going to stand up and go, you know that brilliant system we had? We don't really have that anymore, because they've taken it away. Now, the reason cited for removing the deduction for intangibles for limited companies is to give a level playing field for sole traders and companies. So the way the rules used to work pre-8th of July was that if a company acquired another business and there was goodwill or intangibles with that, the company was entitled to take tax relief for the write-down of that goodwill. From the 8th of July, you can no longer do that. Now, it was cited that it's to make a level playing field. Personally, I think it's got to do with the change in accounting standards, because the way the rules were changing on accounting standards meant that you were going to have to write off, probably within 4 or 5 years, that goodwill. And I think the revenue panicked about the large amounts of deductions that were going to come in on the change of the accounting standards. So FRS 102, I think that's what it was all about. But if you have clients who have transferred or acquired businesses, if they did that pre-8th of July, they're going to be okay. If they've done it post-8th of July, they're not going to get their write-off. So not good news on the intangibles front. But the other thing on the intangibles, what they didn't do was remove goodwill and customer-related intangibles from the regime. All they have said is they're not relevant assets. And that has another knock-on effect, because they don't fall into the capital gains tax rules. But if you sell your goodwill and you sell it at a profit, then that's going to be a trading credit. So it's going to come in as if it was in fact a trading profit. But if you sell it at a loss, then it's not going to come in as a trading loss, it's going to come in as a non-trading credit. So if you can't use it in the year you make the loss, you're going to be very restricted in how you relieve it going forward. So this hasn't been thought out, because there's a lot of things in there that are going to catch out advisors and their clients. Entrepreneurs relief. You know what? I love entrepreneurs relief. And the reason I love it is because we had taper relief for years and nothing really changed. Entrepreneurs relief is brilliant. We've had loads of changes. There's lots of planning around with it. And we've also had lots of first-tier tribunal cases. So we've had lots of issues before the courts. But one of the things that we used to do quite a bit, and as with other advisors, if you had a situation where you had some individuals who wanted to invest into a company, but they weren't going to meet the 5% test. So remember, the key test for entrepreneurs relief is you have to have 5% of the company, the ordinary share capital being the nominal value, giving you at least 5% of the votes, and have held your shares for 12 months and been an employee of a director. They're the three main tests. If you couldn't do the 5% tests, what you could do is a group of individuals could group together, put their money into a company, and that company then would subscribe for the shares in the company they wanted to subscribe for their shares in. So if you had, say, 5 individuals, and those 5 individuals, let's say they were going to get 3% each, so none of them will qualify for entrepreneurs relief. Those 5 individuals could set up a limited company, each owing 20% of that limited company. That limited company would then invest in the other company 15%. And the definition of a trading company or a trading group said if you had what was referred to as qualifying joint venture, where you had at least 10% in another company, then that 10% could be treated as if it was the trading activities of the other company. So that meant that that company owning the 15% was actually a trading company. So you met the test for entrepreneurs relief. Now, that's been going around since 2008. It has taken the revenue until 2015 to do something about it. And what they have done is they've taken the classic sledgehammer here to solve this problem, because this has had a real knock-on effect. And what they've said is from the 18th of March 2015 that you need to, from the 18th March 2015, that if you have a situation where you have that 15% interest, then that no longer is a qualifying joint venture, which means that going forward, that company that they each have 20% in, that is now treated as if it owns an investment rather than the see-throughness. So we've lost that benefit. Now, commercially, this has a knock-on effect for people who, ordinary trading companies who've invested into some activities they thought were trading, but it's had a much bigger knock-on effect, because when restricting the definition of what's meant by a trading company, what the Treasury have done is they've said, and LLPs. So that means if you have a company that invests in an LLP, then for the purposes of entrepreneurs relief, that LLP is not see-through. Now, normally LLPs, partnerships, are see-through for all tax purposes. So this is an exception to the rule. So if you have basically a corporate partner, then that corporate partner has a share in the LLP, then that's treated as an investment. So you cannot say that the trade of the LLP is being carried on by the limited company. So i.e. the company is now an investment company, is not a trading company, and you're not going to get entrepreneurs relief. That changes only for entrepreneurs relief. So it's still treated as see-through for the other taxes. So for direct tax purposes, for corporation tax purposes. So if you have a client who's stuck in that kind of position, maybe you want to consider incorporating the LLP into the limited company and getting your entrepreneurs relief back. But you have in effect restarted that entrepreneurs relief clock. But luckily for entrepreneurs relief, we only have that 12 months test. Now, the other changes we've had is this is where somebody's exiting a business. Let's say they have an associated disposal. Now, you're only going to have an associated disposal for a partnership or a limited company. And if you sell your shares, then you're selling an associated asset, say a factory that you hold outside the company, you should get entrepreneurs relief. The difficulty is if someone wanted to buy that factory that was outside the company, did you get entrepreneurs relief if you weren't disposing of any of the shares? The answer was no. So how would you do it? Well, you'd have to engineer a disposal of the shares, which could be a gift of the shares to a family member, which would be a disposal which would qualify for entrepreneurs relief in the event you claimed it. So you would get your associated disposal. What the revenue have confirmed is that now you have to dispose of at least 5% in order to fall into the associated company rules. So that's a good change because it gives us some clarity. Finance costs and landlords. Have you looked at these rules? So this is another attack on the owners of residential properties. So if you have a situation where you have clients who have substantial property portfolios, investment properties, residential, going forward from 2016, the interest relief is going to be restricted. So what's going to happen is, in effect, higher rate taxpayers and additional rate taxpayers will only get tax relief at a rate of 20% on the interest paid in connection with those properties. Sounds very harsh, doesn't it? And if you look at the way the rules are going to work, so for 16-17, we're going to have 100% deduction of the interest, going right down to 2021, when you're going to have a restriction to the basic rate band. So by the time we get to 2021, it's going to be a restriction so that 100% of the interest will only be relievable at 20%. And it's going to be brought in as a tax reducer. So if you have a client who's making losses in other areas and maybe isn't paying tax, then they won't be able to use it because they won't have enough tax to frank it. So it's going to be a massive change. Now, I got somebody to put together some numbers on this, and he was quite ambitious because he put together one on a client who has 500,000 of rental property income I don't know how many of your clients have that much rental property income. Probably not many. But it does illustrate how the rules are going to work. So if we look at 16, 17, 500,000 of rental property income, costs 30,000, interest 250,000, and then your taxable profits coming out at 220, assuming the person pays tax 45%. We're going to have tax payable on rental profits of 78,700, so 35.8% tax roughly. Because of the way the reducer is going to work and the restrictions going to work, by the time they get to 2021, it's going to be 64% taxed on that. So that's a massive increase. So how are you going to talk to your clients about this one? The first one is, it's only going to affect people who are fairly highly geared. If you have a client who's probably only got one property, he's probably going to be okay. If they've got more than that, you need to start looking at the numbers. So is there anything you can do to protect against it? Now, if you go onto the internet, as I'm sure you do quite a lot, and you read these forums and all the different accounting forums out there, the answer is probably everyone's going to incorporate, because that's great, because we've got 20% corporation tax. You're going to get a 20% relief if you incorporate. So you're actually no better off. You're getting the same relief. Where you are better off in incorporating into a limited company is that at least you have the choice to keep the money in the limited company and only pay the additional tax if you take it out using the new dividend tax rates. So it may be a way to shelter the profits or to defer the tax by rolling your property portfolio into a limited company. Have any of you done that? This is, if you're, I am seriously a tax nerd, and this is quite interesting. If you incorporate your property portfolio and you use Section 162, so the incorporation relief, you take, let's say your property portfolio cost you 100,000. It's now worth £1 million, so 900,000 again sitting there. What you can do is you can incorporate your property portfolio into a limited company and pay no capital gains tax because you use Section 162 relief. Your properties go into your company at a market value of £1 million. So if you sold those properties next day, you would have zero corporation tax because there is no gain. So where's the gain gone? Well, the gain is sitting in the shares in the company, your shareholders, because your shares in the company are only worth £100,000. But if you have clients who are looking at building property portfolios to pass down to the next generations, then it may be worth putting them in through a limited company, getting the uplift in the base costs of those properties, and then they can recycle their portfolios, refresh their portfolios with minimal tax charge. Now, I'm a real cynic, and in my mind, I keep thinking, well, I can see where this is going. You know, the interest relief is restricted for people with investment property portfolios, residential properties only. So what does everyone do? Knee-jerk reaction, let's throw them all into limited companies. And then they all go into limited companies, and then in 2 years' time, the Chancellor will stand up and goes, we're introducing a new corporation tax rate for investment companies. And then we see a hike in the investment company rate, I don't know, maybe up to 35, 40%. So, you know, we don't have a crystal ball. We don't know where we're going to go with this. But I think what you do need to talk to your clients about is the restriction that's going to be on the interest relief. And you may need to consider how you do it going forward. Because in most cases, if you have people with a few residential properties, what you would do is you'd always get them to borrow on their rental properties and use that then to acquire their main residence, because you are putting all the borrowings against those rental properties, and you won't be able to do that now, and that's the difficulty.
Well, can I just very quickly?
Yes.
If you've got a company, if you had a company that was trading,
Yeah.
and decided to change its use slightly and incorporate some properties that were residential investment properties, would that company become an investment company by default, or would it remain?
Right, did everyone hear the question?
No.
It's basically, if you have a trading company and you decide to bring your property investments into your trading company, does that make it an investment company? Well, it depends what purpose we're talking. So if we're looking at entrepreneurs relief, that's an 80-20 test. You need to be 80% trading, but you can be 20% something else. If you're looking at business property relief, well, business property relief needs to be, well, you're mainly not an investment company, so you've got a bit more flexibility. So I suppose what you need to look at, what's important to your client. Is it selling the shares in the company and getting 10% tax rate, or is it qualifying for business property relief and being able to pass the shares to the next generation? And if it is the latter, then they can probably go to 51%, 49%, and still qualify for business property relief. Because the investment is a business, and you can still have the trading. So it really depends what your client's objectives are.
Property portfolio you're bringing into the limited company, if those residential properties are of substantial value, aren't you then putting them to the new ATED tax?
Well, if they're rented out, then you can claim the exemption because they're rental property. What you may want to consider is stamp duty land tax, because if you're going as an individual into a company, then it's treated as market value regardless of the consideration. If you're going in from a partnership, then there's scope to get in there without any SDLT. But yeah, you're right, you do need to consider, and I'm going to come on to very quickly to talk about changes for non-DOMs, and residential properties in companies is a no-no for non-DOMs now. There's a consultation on repair on wear and tear. So we used to have a 10% allowance, and the idea being you get 10% on wear and tear. We asked the government for a replacement in the sense that, so if you had something in your property, your rental property, and you replaced it, you should be allowed to get the replacement. They said, no way, we're never going to do that. They released a consultation, which is in effect the replacement rules. So what it's looking at doing is if you're replacing any furnishings or anything, you should be able to get, not the first time they go into the property, but when you replace the item, you should get a full deduction. Or if you're not within those rules, then you should be able to treat it as a repair. Now, repairs and rental properties is a nightmare. So if you have a kitchen in the rental property and you rip out the kitchen and put in a whole new kitchen, do you get relief for that? Some say yes, some say no. See, it's mixed. Well, you see, you've got to look at it, is it a repair? Because it would be a repair. Because if you think, when you look at your rental property, you're looking at the whole house, you're not looking at the kitchen. Now, if you just look at it as if the asset was the kitchen, then if it's not a repair, if it's a full replacement, you wouldn't get it. But if you think of the kitchen as being part of the asset, because the asset being the house, then you would get 100% relief for your kitchen. Now, see, and that's the difficulty, because tax inspectors disagree on that point. You know, what is the asset you are repairing? Are you repairing the kitchen or are you repairing the house? I'm an optimist with this. I've always been repairing the house and getting 100% relief. This is a list of how the furniture will work and what goes in. And, you know, things like your bath and your fitted kitchen are not going to be covered because you can already get relief for those as a repair. And there was a meeting with the revenue to talk about these kind of things as, well, you know, what's an integral feature in a house? And this inspector stood up and said, well, I see it as if you got your house and you turned it upside down, because that's what most people do. Whatever falls out of the house is an integral, and whatever stays in the house is integral. So they went through various items and they said, boiler, and she went, no, that's not integral, because some people take that with them when they move. I've never seen anyone take a boiler. Changes to non-DOMs. Now, this is something that was on the headlines for quite a long time. You know, these naughty non-DOMs, they're coming into this country, they're not paying any tax, and then they're taking all the money offshore again. So there was, you know, a big consultation as to how you can deal with non-DOMs, and there was a paper released, and there's another consultation paper with the idea that legislation is going to be introduced in 2016 Finance Act, effective from 2017. And under the new rules, where somebody has been resident in the UK for 15 out of 20 years, they will now be deemed domicile for income tax purposes, capital gains tax purposes, and inheritance tax purposes. Now, what the Revenue's briefing note did confirm is that the idea of an excluded property trust will continue. So if you have clients who are here less than 17 years, you still have some time to plan and create an excluded property trust before these new rules come in. So you need to be looking at what you can do for these clients. Now, have you had a look at this paper? It's really, really interesting. And I say that because I'm an Irish domicile, so I'm okay. But if you have a UK domicile of origin and you leave the UK and you get a domicile overseas, the second you set foot into the UK again, you get your UK domicile back. So you don't get the benefit of that 15 out of 20 year rule. So the proposals as they stand discriminate against people with a UK domicile of origin. And, you know, we pointed some examples out to the Revenue. So take the example of somebody who's born to a UK parent in the UK. The parents emigrate to Canada, the individual lives in Canada for 40 years, becomes a Canadian citizen, gets sent back by their firm to work for 18 months in London, never having been in the UK before in their life. They set foot in the UK, they're domiciled. So should they die when they're in the UK, then their assets across worldwide are subject to UK inheritance tax and they're not entitled to claim the remittance basis. So when that was pointed out to the revenue said yes, we could see that in a small minority of cases, they would be worse off, but we could make the rules worse. So they have no intention of changing that. So where you need to be careful is if you have clients who have a UK domicile of origin, but they've changed that, then the second they set foot into the UK, then that comes back to them. And that's why I was smiling, because although I might be deemed domicile here for tax purposes, if I leave the UK, I can stay out and come back and have the 15 and 20 years again. So sometimes it pays to be Irish. The other change, which is mentioned at the bottom of that slide, is from 2017, all UK residential property, whether held directly or indirectly, will be subject to UK inheritance tax. Very quickly. Can I go on for another 5 minutes? Is that okay? Are you okay with that? 5 more minutes. I'll be fast. So the way the rules are working was the Treasury looked and said, all these people are holding properties through limited companies. Why are they doing this? What's the tax advantage? It's SDLT, so we'll bring in a new 15% SDLT rates for residential properties in limited companies. And when we're at it, we'll bring in that added for high-value residential properties and we'll charge you that annual tax. Now everyone's going to de-envelope. Nobody de-enveloped. So the Treasury are there scratching their heads going, why are people keeping these companies? We're not following it. What they didn't realise was actually the reason they were keeping the properties in the limited companies was that was very effective IHT planning for non-domiciles. So they could be in the UK, have the residential property in a company, the company's owned by a trust. It's an overseas company, so you haven't got UK situs assets, so there was no inheritance tax charge. The revenue have finally twigged onto that. And that's why these new rules are coming in. So even if it's in a company, it will become a UK situs asset. Now, the rules aren't out on this. We don't know exactly how it's going to work. And, what happens if you've got a load of things in the company? How do they work out which bit is subject to UK inheritance tax? If you have a loan against the shares in the company, how is that going to work? But what they have said is there will be a temporary relief for people who want to de-envelope. So, i.e., you can get rid of your corporate structure in a way that doesn't trigger a tax charge. But that will be a temporary relief, probably for 1 year or 2 years. And if you don't de-envelope in that period of time, then you will be subject to a tax charge at a later date when you de-envelope. The very last thing, main residence nil rate ban. Now this was brilliant. Do you remember the headlines before the budget? Everyone's going to get £1 million property will be free from inheritance tax. What they didn't tell you was actually, that's part of your nil rate bans. You're still going to get your nil rate band of 325,000, and that will be topped up with another 175,000 that will take you to 500,000. And then, assuming you're married, you'll have the other person's band as well, and that's how you get to your 1 million. So not every individual is going to get 1 million. But the idea is that where you have an estate that's worth less than £2 million, then you'll be in a position to claim an exemption, in fact have an enhanced nil rate band of £1 million, but it's not coming in straight away. So it's going to be phased in over a number of years, starting at 100,000 in 17-18 and increasing to 175,000 by 2021. The good news is it's a bit like the transferable nil rate band, that if you have a situation where somebody has already died, then you will get the benefit of their band. There are going to be some rules in there for downsizing. So let's suppose someone's downsized their property. Then if they've downsized after the 8th of July 2015, they will still be able to benefit from this enhanced nil rate band. If they've downsized pre the 8th of July 2015, it's tough luck. They won't be able to benefit from it. And the condition is that the property must at some stage have been the individual's residence, and it must be included in their estate for inheritance tax purposes. So they're the two conditions you need to meet in order to get the relief. And the property must be left to a lineal descendant. So children, stepchildren, grandchildren. So for any of your clients who don't have children, they're not going to get this enhanced allowance. So it's only available if you're leaving it to children. And they can be adopted children, foster children, any kind of children. So that was very much a whistle-stop tour of the budget. But thank you very much for listening, and I am around if anyone's got any questions.